Alors, bonjour à tous, je me présente Carl Morin, président de CFA Québec. Au nom de CFA Québec, je vous souhaite la bienvenue à ce webinaire intitulé Soirée de débat version midi. C'est la 11e édition de cet événement où traditionnellement on se regroupe en soirée au Musée des Beaux-Arts de Québec. Mais pour des raisons qu'on connaît, cette année, on est en webinaire, mais on espère pouvoir revenir en présentiel l'an prochain. Avant de commencer, je tiens à remercier les partenaires majeurs annuels de CFA Québec qui, par leur précieux soutien, rendent possible la réalisation de nos événements tout au long de l'année. Je les nomme Finance Montréal, Caisse de dépôt et placement du Québec, Desjardins, IA Groupe financier, Fiera Capital, Beneva, AlphaFix et BlackRock. Merci également à Piedestal Productions pour la réalisation technique. L'événement se déroulera en 3 temps. Dans un premier temps, il y aura une présentation des conférenciers, puis suivront des échanges entre les conférenciers et notre modérateur. Et pour finir, il y aura une période des questions. Les questions peuvent être posées en écrivant directement dans le chat. Nous ne pourrons probablement pas répondre à toutes les questions, alors on vous remercie de votre compréhension. Je vous présente maintenant le modérateur de l'événement, M. Sébastien McMahon. Après avoir accumulé plus de 15 années d'expérience dans les secteurs privés et publics, Sébastien s'est joint à l'équipe économique d'IA Groupe financier en janvier 2013. En plus de son rôle en tant que gestionnaire de portefeuille senior avec des actifs dépassant 10 milliards de dollars, Sébastien agit en tant qu'économiste senior et est membre du comité d'allocation d'actifs de la firme. Sébastien agit également comme conférencier et auteur de plusieurs communications destinées à la clientèle de IA Groupe financier. Sébastien, merci beaucoup d'avoir accepté notre invitation et bon webinaire à tous.
Parfait. Merci beaucoup, Carl. C'est bien gentil. Surtout, merci à CFA Québec de m'avoir fait l'honneur de me demander d'être modérateur pour cet événement phare-là, qui est tellement important dans la ville de Québec, notre communauté financière. L'an dernier, on m'avait demandé d'être le modérateur, de m'occuper de trouver des conférenciers, puis j'avais trouvé un programme que j'aimais énormément. 2 invités de marque, M. David Fingold, M. Ed Devlin. Mais malheureusement, avec la COVID, vous vous rappelez, on a été obligé d'annuler. Quand on m'a demandé cette année, OK, est-ce qu'on peut faire une version midi, je vais reprendre le même programme, j'ai rapproché encore les mêmes personnes et puis vous allez voir, on va avoir une soirée, pas une soirée, mais un midi de débat qui va être fort intéressant. Donc, now I'll switch to English. We're going to be doing this thing in English, so I'll be introducing our two guests. First, I will be introducing our guest, David Fingold. So David Fingold has been a key member of Dynamic's investment team since his arrival in 2002. He is a lead portfolio manager for a number of US and global strategies, and prior to joining Dynamic, spent 7 years as part of a team actively managing equity portfolios for a privately owned merchant bank. David's keen interest in restructuring companies is the result of considerable professional experience focusing on businesses core competencies and running organizations to maximize free cash flow. David's work has been widely acknowledged with a number of industry awards. At IA, I invest personally and professionally in David's funds. I've known David for a few years, been on the road with David when we do the tours with IA. So very proud to have him here, and his performance record speaks for himself. The notable contributions to the firm and a management of flagship funds that led him to be appointed as vice president and senior portfolio manager in 2018. Our other guest is Ed Devlin. Everyone here knows Ed is the founder of the Devlin Capital, but he's recently retired as a managing director, lead portfolio manager for US total return portfolios, and head of Canadian portfolio management after about 15 years at the PIMCO. Ed was the co-founder of PIMCO Canada and led to the business that rose $50 billion from Canadian clients. From 2009 to 2014, Ed was based in London. Before that, prior to joining PIMCO in 2006, he worked in London, Tokyo, Toronto, Hong Kong, New York, and progressively more senior fixed income positions at the Lehman Brothers and Merrill Lynch. And finally, a long resume, in March 2021, he was named the senior fellow at the CD Howe Institute. So the way that we're going to be working today is that we'll have opening remarks from both of our speakers, Ed first, David second, and then after that, we'll go into a very interesting topics for debate. So Ed, I hand it over to you. You're on mute, Ed.
All right. Am I now good?
Yep.
Sorry about that. Well, Sebastian, thank you very much for the rather long and very kind introduction. Merci, everyone. I'm sorry for my painful English, but I want to thank you for the invitation to speak again here at the Quebec City CFA. I will try to keep my opening remarks kind of brief, so we can kind of get into some of the interesting questions and topics the society has for us. I think when I look forward in terms of our macro view, look at really very much the year of recovery, the reopening. I look at it being, from a global perspective, going to be very uneven, where we're going to have regions such as the U.S. and Canada leading the way, and parts of the emerging markets and China as well leading the way. But you're going to have some real pockets in the emerging markets that are not going to be doing as well. Mainly related to the pandemic. I think the key thing to look at, and it's the number one overwhelming theme, I think not only of 2021, but 2022, 2023, at least, will be inflation. And we have seen, we're coming off a period since the Great Recession where the developed central banks, the Bank of Canada, the Fed, the ECB, and others have all missed their inflation target to the downside. And so the problem has been, can we successfully reflate the developed market world in a way that we can get ourselves out of the debt trap? And at best, it's been a mixed result. Neither the Bank of Canada nor the Fed have been able to hit the 2% target. And the bigger risk, if you think of the risk to the upside and the downside, has been disinflationary or deflationary, or said another way, the Japanification of our developed markets. And so, looked like we were making a little headway, and sure enough, we got sideswiped by this pandemic. And now we have this massive policy response. So the real question is, now that we're reopening, what's going to happen? And so really, in terms of Canada and the US, we're going to see a spike in inflation, mainly a lot of transitory effects, which the central banks have been talking about, in terms of base effects, in terms of supply chains being disrupted, commodity prices being elevated, again, some of that supply chain related. But we would expect some of that to pass. But we've obviously got a huge output gap still, a lot of unemployment still to be solved, a lot of inequality and social issues still to be resolved. And so, I think the key thing here will be, on a go forward-looking basis, what is this? What happens to inflation, and what is the central bank's response to that? And here in Canada, the key thing that we've got this time around is the Bank of Canada has never before had to navigate a tightening cycle, potentially a tightening cycle, we hope so, with a massive balance sheet. And this is, while the Fed tried to do it, and the last cycle, and they had their taper tantrum, and so that didn't go as well as they'd hoped. I think, the Bank of Canada is going to learn from the Fed, but they're going to have issues. And I think the key thing here is going to be, we're starting from a pretty frothy market condition in terms of bond yields being low, stock markets being high, relatively speaking, and that a tremendous amount of uncertainty about when does the central bank pull away the punch bowl? When do they start to contract the balance sheet? When do they start to hike rates? I would be inclined, and I think our baseline, I think what they should do, and what I hope they will do, at least initially, will be to keep rates low, and let's try to see a bit of inflation. Let the transitory go through, and let's see what the second round effects will be. I think both the Fed and the Bank of Canada want to see inflation relatively consistently once we see the noise go through in that 2 to 3% range, rather than the 1 to 2% range we've been in the last decade or so. And so that's what they should do. I think what we're going to see is a lot of noise. Markets are going to panic about the withdrawal of monetary policy or not, which is going to whipsaw markets around. And the other thing it's going to be interesting to watch is, do policymakers keep their nerve and stay the course, or do they start to hike rates when they see inflation, and then reverse course when you get big stock market corrections, the infamous Greenspan, or we can just call it the Fed put, where every time the stock market corrects, they feel an urge to accommodate. So I think that is the kind of the key context within the next call it a couple of years. Do expect that rates will get off zero, do expect the balance sheet will contract, but I think there's a lot of noise. And I think that's the key thing for investors, is to have a long-term view and then stick with it and take the other side of the noise when it presents itself. I'm in the camp that interest rates are not going significantly higher, probably for the next decade or so. One of the reasons I left PIMCO to start my own firm was I just don't believe public bonds will be a terrific investment, over call the next 5 or 10 years. So within that context, I think that's how you allocate capital. In terms of portfolio construction, as I said a bit earlier, I would be very conservative or underweight public bonds as well as public equities. I do see some value in the private markets in terms of private debt, which has been the focus, will be the focus of my new firm, Devlin Capital, as well as private equity, where I think there's some really interesting opportunities and some disruptive technologies. And the other thing to have in terms of portfolio construction is be overweight cash. Bonds are not the greatest hedge for dips in the market. Probably better to have cash. Maybe think about some other hedging strategies. We can talk about that later. But so overweight cash, underweight public securities, overweight private securities would be the general portfolio construction I would suggest at this point in the cycle. So maybe just stop my remarks right there, and hopefully that's clear, and be happy to answer any questions.
Yeah, that sets the table pretty well for a few discussion topics down the road. So now, David, enlighten us with your outlook.
Thank you. Look, we're bullish, and I'll start out just by telling you why and name some of the most important macro indicators we would follow in order to be bullish. So most importantly, it's credit markets. Credit is the life's blood of the economy. The economy really can't grow if bond managers aren't buying corporate bonds, if banks are not lending. So we monitor credit. And what we see makes us bullish in the sense that high yield is performing well versus investment grade. Within high yield, the lower quality sectors of high yield are doing well relative to the higher quality sectors. The industries that were most depressed during the recession, for instance, those related to energy, those related to consumer durables, credit is getting better in those sectors. So we are seeing a broad improvement in credit, and that makes us bullish. There are other things that we look at. There's a lot of noise in the daily readouts on these series, but we do like small versus large. We do like international versus US. We do like copper versus gold, cyclicals versus defensives. They're all acting like we're in the relatively early stages of an economic expansion. Now, to be clear about this, there can be bumps in the road. There are always bumps in the road. The economy never grows in a straight line. But we have a lot of pent-up demand, and we have a lot of credit available, and I think it makes sense to be optimistic. We build portfolios to take advantage of this, probably most holistically within our asset allocation fund, because that fund's able to invest basically in any asset class that an 81-102 mutual fund is allowed to invest in, and also some asset classes where we have exemptive relief. So we really look at everything. But I think that what's different about the way how we look at it is we don't have target ranges for any asset. I mean, I think that generally speaking in the industry, most people would communicate, we have a certain minimum or maximum corporate bonds, a certain minimum or maximum in commodities, et cetera. We don't have really a minimum or maximum of anything. We look at the asset classes and say, is there an opportunity to receive a risk-adjusted return that compensates us for the risks that we're going to take? Does it make sense, and does it fit in within the low to medium risk classification of the fund? And it could be physical gold bullion, or it could be no commodities at all. It could be a big position in corporate bonds or no corporate bonds at all. Right now, we are only invested in three things: Canadian dollar cash, which is a small position, a slightly larger position in short-term US Treasury bills, and then the preponderance of the portfolio is invested in 25 companies, which are high-quality equities with a particular focus on cyclicals and with more of a focus internationally versus the United States. And again, I'm in no way negative about our companies in the United States, but most of them are more outward-looking companies focused on the growth around the world, because there are lots of parts of the global economy that have yet to accelerate, and the US is already doing very well. Now, I'm a bottom-up stock picker. The way that I integrate macro views into what we do is we worry top-down. So, I was at the Columbia University Value Investing Conference about 10 years ago, and Bruce Greenwald was talking about how the value managers who survived the crisis, that is the global financial crisis, were those who understood that a material adverse change from macro could change the fundamentals of a stock that they'd picked. So we worry top down. We look at every one of our positions and we say, if currencies change dramatically, would it still be a good investment? If rates change dramatically, would it be a good investment? If commodity prices change dramatically, would it make sense to own that, to own the equity of that issuer? And if the answer to that is no, we don't get involved. Wherever possible, we're looking for situations where we're going to earn an attractive risk-adjusted return, and that any effects of macro are asymmetrically in our favor. For instance, if we own a high-quality financial institution, we would benefit from higher rates. Lower rates within reason wouldn't help a higher quality institution. So that would be an example of a kind of an asymmetry we'd look at. The only other thing I think there's again different about our approach is that our equity selection is generally to look for dividend growth. Dividend growth has been one of the best performing factors in the long term. I believe it continues to be so, especially on a risk-adjusted basis. I'll just remind everybody that the best dividend growth comes from companies initiating their first dividends, and it comes from companies that have low dividend payout ratios and low yields. They are the ones most rapidly increasing their dividends. So we are conservative growth investors, and we're optimistic, and that's where we're coming from right now.
Right, good, thank you. So thanks for the outlooks, and already have a ton of notes for our Q&A. So the first topic I would like to hear you, probably Ed, going first. Ed, you mentioned your view on inflation. You expect inflation to come at some point, and I took away that you think that the strategies of central banks now would be to keep rates low and basically see what happens, and if inflation finally happens. So we're kind of getting near modern monetary theory, where central banks are just there to finance debt, and debt doesn't matter anymore. So could you dig deeper into how you think, and if you think inflation will happen, and how to position for it?
Right. So, inflation is going to happen initially kind of in a very uneven fashion and up. It's going to happen. So, and we're seeing that as we see, because again, just base effects. If you think the economy went down, the economy's going up, there's a lot of noise in there that if you're just looking at rates of change, which is what inflation is, it's going to have a lot of noise. So let's just kind of look through that for a second, right? Then I think what you're looking at is, central banks, we've had a ton of fiscal stimulus, right? Unprecedented amounts, both in the US and in Canada, and in Canada in particular, but both of the Fed, unprecedented expansion of their balance sheet. So the real question is now, how do you manage monetary policy when you've got a massive balance sheet and you're supposed to be just controlling it with interest rates? And I think that is really the challenge. That's a part of the article I'll be writing with C.T. Howe in not too long. And I think the answer to the question is very simple. Inflation, a real focus on inflation, right? And what they're going to want to do is see inflation a little higher than target, rather than being a bit lower than target. And the other thing they've got to do, and it leads back to David's comment, which I thought was really interesting about him being bullish on stocks because he was bullish on the credit markets, is you got to keep a really close eye on those credit markets, because I would argue they're not private sector driven credit markets. They're central bank driven credit markets, especially in the US, where you have the Fed, directly intervening in the credit markets, high yield and investment grade, more than Canada did. And so, that withdrawal of the central bank, which I think can be done, right, and can be done successfully. So I'm not saying David's view is incorrect or anything, but I think there's just risks there. And I think the risk of that handoff between the central bank to the private markets in credit is going to be a real key thing to watch. And I think that's why central banks will want to support the credit market. So I agree with David on that, but at the same time, they're going to want to withdraw from the credit markets, and they're wanting to see inflation being higher. And they're going to want to inflate away that. So it's going to be what we would call financial repression, which in other words, you want to keep nominal rates lower than inflation for a while in order to A, curb your debt to GDP numbers, but B, also secure inflation expectations, because I think central banks worry a lot more about disinflation and deflation than they do about inflation.
Okay, good. David?
Look, I think that inflation would be a high quality problem because I think it's extraordinary how much focus it's getting today. Even though 12 months ago and even maybe 24 months ago, people were talking about stagnation, they were talking about deflation. So now they're talking about inflation. And as my late father would always say, be careful what you wish for, you may get it. But in this case, I think that some inflation would be constructive, just given what we were worried about so recently. The other thing that I'd say about it is that it's easily addressable within the equity market, and it's addressable through pricing power. Mr. Buffett was asked by the Financial Crisis Inquiry Committee what the number one attribute was that he looked for within a business, and he said it was pricing power. And I agree with him. I just also want to make it clear that it's not extreme pricing power. It's not jacking up prices in a way that causes a highly negative customer reaction. Charlie Munger was adamant that that behavior, and I think he cited Valiant at last year's annual meeting, was a specific example of an inappropriate action vis-a-vis pricing power because it was unsustainable. Look, that's how we invest. I'm frankly worried about the alternative. I'm trying to make sure that when we've made equity investments, that if raw material prices are higher, labor prices are higher, that my companies can go get a reasonable price increase. And similarly, I want to be involved with companies where if prices do back off and commodity prices are going to face a base effect 12 months from now, and the rate of change is going to fall, I imagine. And I would like my companies to be able to keep their price increases and not have to give price back. So, I think that that's the best insurance against inflation, is to invest in good businesses.
Okay, so if we have a world of still low interest rates, as Ed, you expect, and we have some inflation, we still are in a low real return kind of world for a few years to come, right?
Yeah, I mean, and that's where I would say, as I said earlier, I think bond returns are not going to be particularly attractive. If you ask me in the public markets, would you prefer to be in bonds versus stocks? I would agree with David, it's stocks.
Okay, good. All right. So maybe that leads me to the second topic we could cover, the topic of factors. So people are looking now at alternative and say, well, maybe you should not look at the world in terms of asset classes, but there are some risk premiums that you can just reap through factors. So maybe starting with you, David, first, do you believe in the existence of factors? Because as I said, I've done a lot of tours with you and people were always saying, well, David Fingal is a quality factor guy. So first, do you agree with that label? And do you look at factors when you invest?
Look, we absolutely do look at them. So I'll start with the simplistic view, which is that the quality factor has outperformed in the long term. So has the dividend growth factor. And I'll remind everybody that what works in the long term does not necessarily work in the short term, and what works most of the time does not work all of the time. An important aspect of investing is to adjust one's ego to understand that even if you're right most of the time, you have to live through the times when you aren't right, and you want to minimize the negative impact of the times when you're wrong, because it will happen. The other thing that I would say about those factors, and I think it's very important, is that they're completely different than the factors on the fixed income side. In other words, reminding everybody we have a balanced fund, the asset allocation fund. If we had a bond in there, if it were a corporate bond, the change in its spread, measures of duration and convexity, those are real, those are measurable, and they impact the fair market value of the bond. It's tougher on the equity side because I do challenge people to measure it, because what happens is when a factor is working, it starts to correlate with the momentum factor. And again, for anyone who's run a regression, you know how big, the error item can get, and how little of the actual trend of a security is getting measured by each individual factor. So I'd warn people against quantitative factor investing. But I do want to know what's going on. If we're exposed to a factor, it's a risk we have to manage. And my belief is to always be looking at that, because the alternative is to have one's head in the sand. And I don't think that ostriches should be managing money.
Yeah, good. So Ed, coming from the fixed income world, what's your view on factors?
Yeah, and David and I would agree that the factors in fixed income are more precise, in terms of duration, convexity, credit spreads, volatility, et cetera, implied vol. But as with any market, equities, currencies, commodities, correlations change. And so, you've got to be very aware that, in a world where there's low interest rates and large central bank balance sheets could be different where we had high interest rates, right? And, and a lot of this also is driven by market sentiment, right? And so that's where I think that you have to be very clear. But, when I was at PIMCO, we used risk factors a lot. I mean, it was the reason I was able to run, 60 portfolios with 20 different benchmarks as the lead PM, because, when you look at the factors and understand the factors, you have to have a macro view on how factors can change and move. It allows you to be, I think, a lot more precise in fixed income. So I'm a big supporter of factor investing in the fixed income markets.
All right, good. And does that translate also, you think, to alternatives, the use of factors?
Depends on the alternative, right? Okay. So the thing about alternatives, to me, there's like two different kinds of alternatives. One, the good type, and one, the bad type. The bad type is code for imprudent leverage. You're just juicing up a balance sheet, and that's all you're really doing. The good type is when you can access different sectors of the market, different parts of the market. And I kind of when I look at public versus private markets, really the two things you should be looking at in terms of risk premiums that you try to harvest is a complexity risk premium. Maybe there's something in the private markets that's a little more complex and takes some time to understand, and also a liquidity risk premium where you're tying up your money for a while and you have to get paid for that. And so those judgments, making wise judgments about complexity and liquidity premiums, I think can be quite attractive in the private markets, and that's kind of what I'm focusing on now. But you got to be worried about, when you go into alternatives, is it the imprudent levered up version of it, or is it the more prudent version that I think offers some slightly better risk return profiles than maybe the public markets?
Okay, good. Thank you. So just maybe fixed income, when we look at manager surveys, everyone seems to be underweight. Everyone seems to have a good idea that, well, rates are going up. You said that you don't agree with that view. Inflation is coming. So in the post-COVID world, should anyone own fixed income at all? Maybe start with you, Ed, again.
Sure. I mean, I put it this way. If you asked me a couple of months ago when the 10-year rate in Canada was 0.5%, I would probably pound the table and said no. Now that it's like 1.5%, well, a little better. I think we're kind of getting there. I mean, if you just think of the basic bond math, if you think of fixed income being a hedge against, say, bad market conditions in equities or other parts of your portfolio, really, how much capital gains can you get? If we go back to half a percent, you might pick up 8 or 10% in capital gains, right? That's all you got. And if you're squeezing a lemon, the lemon is pretty much squeezed. So I don't think the returns are going to be great. But that being said, I think that the odds of 10-year rates in Canada getting to 2.5% are relatively low. So I'm not a big fan just because of the risk return profile of where we stand right now. I'm also not a big fan that the yields that we should expect in the 2-3% inflation adjusted are going to be pretty terrible. I think you can find better, real rates of return in other sectors of the market. And so, maybe a little, but not a lot would be my bottom line.
Okay, good. David, your view on owning fixed income?
Well, we look at it like anything else, which is there a reason for us to be there? And the answer to that is broadly no. We were very aggressive buyers of credits in 2002 and 2008. There were equity type returns available in credit markets, and the markets simply didn't clear. The Fed basically stepped in and the markets did not clear last year. So we decided not to buy any credit because we didn't see a buying opportunity. And the frustration in around duration has been that broadly since the taper tantrum, in most of the corrective events in the stock market and the technical corrections, that is 10% or more from close to close, duration really didn't act like an asset in most of those events. I mean, in some cases, bonds actually sold off. So we just approached that by zero weighting corporates, and we've been out of that space since 2014, even though we've been loaded with them coming out of the crisis. And in that time period between 2013 and 2015, we backed away from duration. So once upon a time, we would have had 10-year principal strips. Once upon a time, we had JGBs. But today, their sole fixed income asset is short-term U.S. Treasuries. And our longest time to maturity right now is less than 11 months. But our functional currency is Canadian dollars, and the US dollar has risen in every correction since 1970. So it remains a negatively correlated asset with zero credit risk. And unlike US dollar cash, it can trade with a negative yield. And that did, I wished it didn't help us last March, but it did help us last March when the front end of the curve went negative. The other thing I'd ask people broadly about duration is, just given the price value of a basis point at current yields, think about the volatility that's importing into portfolios. And it imported a fair amount of volatility into portfolios last year. And I think that for anybody on this call that's managing money, and you have an investment policy statement and you're laying out some guidance on volatility, I think it was a rude awakening that fixed income was a source of volatility. So, I've openly questioned the utility of fixed income. We're there when it makes sense, but otherwise we're not there.
Okay, good. There's a question we get asked often is that, are we in a bubble? Always which bubble? But if you had to answer that, are we in a bubble somewhere, and where would the bubble be right now?
I think, first of all, asking the question is normal. I mean, I'm not that old. I graduated from business school in 1988. I can tell you, having read Barron's since I was a young man, watched Wall Street Week, followed the financial media, I don't remember ever hearing people say, and I mean the general public, and I mean the financial press, ever say anything other than the things are unsustainable. It always feels like everybody wants to talk about how horrible everything is. There are obviously and by the way, my approach to that's very simple. I'm going to quote our founder, Ned Goodman. He said, "I'm an optimist because I never found a rich pessimist." So that's how we run our business. There are areas that are of concern to me, and we simply avoid those areas. And whether or not they're bubbles are separate matters. I mean, people asked a lot of questions about commercial real estate, and we stayed away last year. Obviously, it had a very difficult year. We now have an improving economy. We have, reopenings. So it is possible for an asset class to get in favor and get ahead of itself. I don't know what those would be today. I would broadly ask people, though, who are involved, say in traditional fixed income portfolios, why do you own it? And does it still fit those goals? And I'm not saying it's a bubble. I'm just saying, and I think one should always say about every asset class, why are you there? Are the reasons why you were there the same as when you got involved? Test your investment hypothesis. To quote Charlie Munger, try to prove the opposite of your investment hypothesis is true. He calls that inverting your investment hypothesis. Do it every morning. If you can invert your investment hypothesis, well, then use your sell discipline. If your hypothesis is still true, if it's still a buy, then you own it. But again, that means you have to be willing to exit asset classes or sell securities when you can invert them. And I don't know how many people can do that, given the prevalence of closet indexing and the prevalence of risk budgets.
Yeah, good. Ed, your view on bubbles.
Yeah, I mean, I just want to follow up on David's comments, which I broadly agree with. But I'd say that some of the exceptions in what you see in the fixed income markets is there's a whole class of institutional pension plans that do what they call liability-driven investing. So when they know the interest rate risk of their liabilities is 15 years or longer, and they know they're fully funded, for them the risk of going way off that liability matching creates a lot of volatility for them. So that's if you ask yourself, why would anyone buy that stuff? There is a natural buyer base, if you will, because it's a liability stream. So that's just something to keep in mind. Although I agree with David, broadly speaking, on valuations. With regards to bubbles, I'm actually, again, doing some research right now on housing in Canada. And, I'm still finalizing, we'll be publishing in the next coming weeks, but it's not clear to me Canadian housing is a bubble. And here's why. I'm not sure. What I'm really focusing in on is like household formation and starts, and that drifts up through time. So, you have to have a sense of that, and that's where my research is, and we're not there yet. So we haven't published, so I won't get ahead of myself, but it's unclear. I'm not in that camp. Did any interest rate sensitive asset, whether that was bonds, houses, a lot of other things, obviously went up when interest rates came down, right? And the reverse will happen. And one of the reasons I think the Bank of Canada nor the Fed, nor any of the developed market world, just be blunt, our interest rates going substantially higher is because we have an enormous stock of debt. The interest rate sensitivity of the developed markets is so high that we can't afford interest rates to go up because it would take the economies to their knees, and the central banks don't want to bring the economies to their knees. So, while people might say it's a bubble, it might in fixed income. I'm not sure it's a bubble in fixed income, but I think it could be a long-term, relatively unattractive asset class without getting killed, because I don't think that we're going to have long-term high interest rates for a sustained period of time. So I don't really buy it too much in fixed income. Unclear in Canadian housing. The one thing that was very clear, and when I was at PIMCO, we were probably 2 years ahead of the housing crash, is we saw that, the loose mortgage credit built up to too much supply. We overbuilt by about, I can't remember the number, 6 or 8 million houses. And then that's what led to a prolonged period where we had to work through that supply. It's not clear to me in Canada that we have that oversupply and that it's going to be a long time. So, unclear, but we should be very careful of, be very cognizant of it. And I'm basically in agreement with the starting of tightening of mortgage credit that Ottawa is doing in order to prevent something before it happens, a big overbuild, that is.
Yeah, and a follow-up question, how worried are you about Canadian household debt?
Well, I'd say just broadly speaking, consumer debt, whether it was mortgages being the biggest piece of it, is yes, very. And the central bank just did their financial stability review, and something like 22% of all new mortgages were to people where the debt was 4.5 times their income. So the highest, most vulnerable. So people are borrowing too much. So average statistics, and this is what we saw in the US too with mortgage credit. Remember Ben Bernanke famously said, subprime mortgages are just a small percent of the market. It doesn't really matter. Well, there was a thing called synthetic CDOs, another thing that we don't have now, we did have then. But I think up here, you got to worry about not the average, you got to worry about the tails. And if we've got a significant number, pick a percentage, 10% or whatever the number is, of people who have gotten over their skis with debt in this low interest rate market and been reckless, it's not going to take much. It only takes 100 or 200 basis points of higher costs for people that to fall over and go into default and cause a macroeconomic event. So yes, I'm very concerned, as is the central bank, about a segment of the market. But and when you say that, at the same time, the savings rate has boomed. So the average person is fine, but it's the marginal borrowers you really have to worry about.
How about you, David? Is it one of the macro factors that can change the investment value of single names? Are we there?
Well, first of all, I have to apologize. I pay absolutely no attention to Canada. We have a Canadian equity team that reports into me, headed by Don Simpson, and he makes the decisions on our views on Canada. I can tell you, when I look at the United States, when I look at Europe, when I look at Japan, I'm not concerned about credit. In fact, I see it getting better. And we do own a number of financial institutions in the United States and in Europe, and and as well in Israel. And they had credit provisions for a severe recession, and very little of that actually got realized. So as the economy's been growing, they've been releasing provisions. So it's really the opposite of the kinds of concerns I hear people ask about Canada, where I really have no expertise. I think it's an important question. I guess if one was looking at Canada, it's just that it's not really part of our universe. When a financial advisor makes an investment on behalf of their clients in a foreign equity fund, a global balanced fund, it's an allocation away from their Canadian portfolio. So we just simply don't count Canada as part of our universe.
Okay, good. But one spot where you are a thought leader is on stock picking, and that talking about bubbles lead me to think about crypto. So how do you view crypto? Does it influence you? Do you have a view on crypto, David?
Well, I think first of all, it's important to divide it up into different pieces. So if somebody's asking a broad question, say about Bitcoin, I think that one of the frustrations with it has been it's been a poor diversifier. I think recently there have been some charts that have made it out there, perhaps even on my social media, suggesting it's not a diversifier because it sells off at the same time as the equity market. So then I guess the question becomes, if it's not a diversifier, then the opportunity would be, well, really, what's the upside and what are the risks? I'm concerned about the risks, and I think that and it keeps us on the sidelines, but it's important to understand, we do have a preferred habitat. Our regulator doesn't allow us to own Bitcoin. I think that if crypto succeeds, it's good for storage and for compute power. So it would be positive for investments in semiconductor capital equipment. So, for instance, an ASM Lithography or a Hoya Corporation. But I think that the broader issue people need to think about is the potential advent of central bank digital currencies. And I think that what people don't think about, two aspects of it. Number one is who will benefit. And I would suggest that the financial institutions that have strongly invested in technology will benefit. A lot of people think fintech will benefit, but the thing is, a big bank has the ability to give you a discount on your mortgage if you use their application to make central bank digital currency payments. And a fintech may not even be able to originate a mortgage. So I do think that it's very interesting for the banks that have made major investments in technology. I would call out as an example First Republic. I think the other question people should ask about central bank digital currency is, will that lead to an event where other cryptocurrencies, where crypto as opposed to central bank digital currency becomes outlawed? Because I really don't understand why the Fed would accept people to accept their coin if other coins were competing with it. They certainly aren't very tolerant of people printing their own currencies and circulating them in the United States. So I'm not making a prediction, but I would just remind everybody that on a certain day in the early 1930s, the Fed did take away everybody's unwrought precious metals. So people should be thinking about what happens in an environment with central bank digital currency. There's some history to suggest you won't get to keep your cryptocurrencies.
Yes, and Ed, I know that through Dividend Capital, you've investing somewhere in crypto. So can you share some of your views and how we can invest in the space?
Well, actually, it's not through my company, but I'm on the board of a fintech company that just launched a music non-fungible token yesterday. So I'm broadly speaking very bearish on cryptos. An outright investment, I don't think they're a store of value. There's no one to trust. At least you have the Fed or the Bank of Canada, with an inflation target when you have fiat currencies, right? I'm not a big fan of gold either, but I've had a lot of debates with that people over the years. So I just don't see the cash flow that falls off of gold, but whatever, we can talk about that later too. So, and I think that the concept that David had there of, being outlawed, I think it's totally a risk for sure. I mean, the other thing I just don't understand about, digital crypto is, quite frankly, you could disintermediate the whole financial system doing that. Like, why would I hold my money at a commercial bank when I can hold it at a central bank? So, you can start to take this thing, the disintermediation can go in a lot of very strange directions very quickly. But what I do like is I do like blockchain, and I do like some of the innovation, the disruption that can come out of here. I think it creates some real value for consumers. And I think that, so you've got right now, for instance, the background, the crypto that we are using for this new launch is a thing called Tezos. It's got a much lower carbon footprint. It's like 1/2 millionth of Bitcoin. Okay, so that's something that's interesting. If you think about what does blockchain do for you, all it does is says you're registered. This is yours, right? You own whatever that bit is, and so it makes it quite good for something like the collectible market. Do people want to do digital collectibles like art, rookie cards, things like that? Well, maybe they do and maybe they don't, right? It's just like any kind of art, physical art. And maybe it'll take off or maybe it won't. But there's things that, I think there's innovations and disruptions, and I think you have to pay attention to them. But crypto to buy a cryptocurrency outright is, I think, is imprudent and unwise.
So would you characterize Bitcoin and Ethereum or Dogecoin or whatever as currencies or commodities? So how would you characterize?
I call them technology, a unit of exchange. It's code. It's a unit of exchange. It's not really, it's only a currency in as much as you can exchange US dollars for it, right? But I can exchange US dollars for cars and just make a car a currency. You know what I mean? I guess we can go back to the bartering system if we really want to, revert backwards. So yeah, I'm not as a sector. I think there's it's like, it's like the dot-com boom in '99, right? A lot of crazy things happened and 90% of them went bust. But the 10% that survived and the innovation like Amazon and others that happened, really did change the world in a positive way. It was a positive, disruptive technology. I'm not exactly sure how this whole crypto thing is going to work out, but I do think there could be some positives. There'll be a lot of carnage. My prediction will be more carnage than positives, but there'll be some positives and there'll be a lot of carnage.
How about you, David? Would crypto make its way into your portfolios someday?
Well, again, we don't, at this time, it isn't permitted by the regulations. Would it appear? I would say likely not in terms of the cryptos that are currently available. We would ask ourselves with the central bank digital currency whether or not it would be interesting to us. Certainly, I do remember during the financial crisis thinking about counterparty risk and it might be easier to use a Bank of Canada or a Federal Reserve digital coin than to find treasury bills when they become special. And, it was very hard to find them during the financial crisis. So it'd be nice to have that tool. The only thing about it is it wouldn't have the same properties. In other words, it's a cash equivalent. So I don't know whether or not it's going to trade above par if rates go negative, and you have that benefit within the treasury bill. So treasury bills feel more attractive to me on that basis because they contain that optionality, and I don't see how a coin would.
Okay, good. So we've painted a broad picture now. Equities might be expensive, but still interesting. Fixed income, the case for public bonds is not as strong as it was before. How do you hedge a portfolio in 2021 going forward? Is this still stocks and bonds, or do we have to be more creative? Maybe Ed.
So I remember, I think one of the reasons I've stayed, all these years and decades in the industry is I remember my first boss at my first job at a Wall Street firm, and we were trying to hedge something, and he goes, what would be a really good hedge for that? He goes, what? Sell it. Get rid of what you own. There's a good hedge for you. So I think, let's not be too complicated. Point number one. So, but there are times when you're maybe the size of your portfolio is so big, you can't sell it, right? And so so when I was at PIMCO, we did a lot of hedging, right? And there's a lot of art to the science. You need a little bit of both. I'm with you in terms of duration not being as an effective a hedge as it was before. I do think with central banks engaging in the markets in a relatively heavy-handed way, there are some other things. Volatility. I used to use a lot of volatility to hedge when I was very long, just after the European debt crisis, and there was good opportunities to buy subordinated debt of the big European banks at pretty nice yields. The biggest risk was if I was going to be wrong, the euro was going to split up, right? So you could hedge that. I'd buy puts on the euro, euro dollar, the cross, and that worked out beautifully for us, kind of thing. So I think options, when central banks artificially suppress options, you can buy options on currency, you can buy options on credit spreads that are available in the debt markets now. You can buy, equity options. I mean, the VIX is down at 18 today. If it got a little lower, I may not be a bad, again, and it also depends what you're hedging. How risky is your portfolio? Are you feeling really aggressive and all you want to do is put some hedges on in case the worst case scenario happens? Or, do you have a conservative portfolio, which might then require a different kind of hedging program? So I think there's a lot of analysis that has to go behind what you got. Why do you need to hedge? Are you really sure you need to hedge? But I think, there are some other things you can do. But it's tough. It's that, and definitely, it used to just be 60-40 stocks, bonds, and the bonds were your hedge. And I think those days of just using that rule of thumb, I think, are long gone.
Good. How about you, David, your way to hedge risks in your portfolio, has it changed profoundly?
Well, it depends upon the opportunity set. So look, the three most dangerous words in finance, it's different. This time, the second three, it's already priced in. And we think the third is, it's okay, we're underweight. So no, we don't believe that's true. That is, if you don't like something, own none of it. Underweight is not correct. The correct amount of something you don't like is none. So we're not trying to hedge things we don't want to own. We only own things we want to own. Then we think about the asymmetries in terms of how they act. I mean, to be blunt, if I look at short-term US Treasury bills, we probably should lose a little bit of money on them in Canadian dollar terms while things are getting better. All right. And I consider that to be a high quality problem and a cheap form of insurance, because if you get a proper correction, 10% close to close, they're going to go up in value. So it's an actual hedge. And until we go off of the dollar standard, if that's what you want to call the current, world organization, the dollar standard, as long as the US dollar goes up during risk off events, it's an effective hedge. The other thing I'd mention is that as much as quality outperforms over time, quality performs consistently when volatility rises. So you can build that right into your equity selection to make it conservative, where you give up less ground during the corrections and during the bear markets. So I think these are things that are easy for clients to understand. They're things that work repeatedly. And I'd also point out that we are not shy about raising cash. I see no indication I should do it today, but I also saw no indication in the middle of February last year that we should raise cash. And then by the middle of March, the global dividend fund was at 35% cash and the global asset allocation was down to 43% equities. Then we got the indications in April that we should put the cash to work. So don't discount cash. I mean, if you don't want to own something, sell it. And cash gives you the optionality to buy it at an attractive price. And, I do like the word that you used, interesting, and in French, intéressant, is a better word. It means potentially profitable. And that's how we see these strategies right now.
Yeah, that's a great point. Cash is often underrated if there is a risk management tool. Maybe before, in the few minutes that we have left, everyone always loves these. So if I start with you, David, your top 3 investments right now.
I would say cyclicals. I think that a lot of people are just enamored with cryptos. They were talking about SPACs. They were talking about meme stocks. The public's imagination never just went into buying high quality cyclical companies that will benefit from an improving economy. The other thing that I would say is international. Between 2016 and 2020, we kept on hearing from clients, the US is outperforming. When will this end? And I said, when the cycle ends. Well, a new cycle started last year, and there's more cyclicals than defensives within the EFA index, say, compared with the S&P 500 or MSCI US. So international, I think, is more interesting, c'est plus intéressant, que les États-Unis maintenant. The other thing, that I would say is what I said earlier about treasuries. You can do this at home. Anybody who has the ability to custody US treasuries, I think they have, that is short-term US treasuries. So you have no duration. You can benefit from them catching a bid during the risk off. And if they stop working, sell them. It's one of the most liquid securities in the world.
Right. Good. How about you, Ed? Top 3.
I keep coming back to the central banks being incredibly accommodative and will be for a very long period of time. And I look at, term premiums in the bond market being compressed. And I look at the equity risk premiums not looking particularly attractive. Equity risk premiums better than, interest rate term premiums, but still, I think you can see a lot of more interesting opportunities, I think, in the private parts of the market, in private equity and in private debt. So I kind of, you got to be selective there. There's a lot of interesting, opportunities there in trade finance and other things. So that would be point number 1. I agree with David. cash is a good hedge. And I'd be right now overweight cash, looking for opportunities. If you think, and I think we're entering a period of turbulence where people are going to get whipsawed in the markets. So do your homework, figure out what stocks you like, figure out where you want to be, and do your research, and then deploy your cash. When you can get a good price, kind of thing. The one thing I think is a defective product, and I've been talking about this for quite some time, is passive corporate bonds. I think all CFAs could agree that there's, probably not a good rule is to lend people money without doing absolutely any homework, right? That seems like a really dumb idea. And so I think what core passive ETFs, passive mutual funds in the corporate bond space are terrible. And by the way, if you ask for a good hedging tool, that's not a bad thing to short too, kind of thing. I think you can get the bang for the buck of not only your risk factor analysis, but the eventual, kind of blow up that inevitably will happen, but it's probably going to take a couple of years. As when that goes, that will go, quite well, I think. And then I guess, I think as I talked about earlier, disruptive technologies. I think there's a lot of interesting things. We just invested in a company out of Caltech, and they've done injection molding, amorphous metals. They can compete in the gearing market at 10% the cost of the dominant German competitors right now. I think there's these really interesting opportunities still in technology, never short human innovation. When you can find opportunities to find really innovative and creative things, I think that'll be a constant through bull markets and bear markets. And if you think public markets are rich, it's a great place to look, and it's what I've been doing recently.
All right, good. Thank you. So I think that wraps up the time that we had. So for the closing words, first, thank you very much personally. Thank you for accepting the invitation to participate into this. I've been following your work for many years. I wanted to make sure everyone get to hear all of the insights that you guys can bring to the table. So it was a privilege for me to moderate this thing today here.
Thank you.
So, sure. And Cal, so I hand it over to you for the closing words.
Well, thank you very much, Mr. Fingal and Mr. Devlin, for sharing your views today. It was definitely a very interesting discussion to listen to. Merci beaucoup aussi à toi, Sébastien, pour l'animation et pour ta contribution dans l'organisation du panel. Merci également à tous les participants et aux partenaires. Cet événement vient clore la saison de CFA Québec, donc merci à vous de nous avoir encouragés pendant cette année bien particulière. Pour nos membres, un petit rappel que l'Assemblée générale annuelle se tiendra le mercredi 16 juin prochain. Vous avez normalement reçu l'invitation, donc merci de confirmer votre présence. On espère vous y voir en grand nombre. Au plaisir de vous retrouver en septembre prochain pour le lancement de la prochaine saison de CFA Québec. Vous pouvez nous suivre sur les réseaux sociaux et voir notre site web pour les mises à jour sur le calendrier de nos événements. Je vous souhaite une belle journée et un merveilleux été.